Ladies and gentlemen, good day, and welcome to the Q3 FY23 earnings conference call of GAIL India Limited, hosted by Antique Stock Broking Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Varatharajan Sivasankaran from Antique Stock Broking. Thank you, and over to you, sir.
Thank you, Michelle. Good evening, everyone. It's my pleasure to welcome all the participants and the management of GAIL India Limited, led by Shri Rakesh Kumar Jain, Director of Finance, along with his other senior executives. On behalf of Antique Stock Broking, it's a pleasure for us to receive you all this evening. I would like to request Shri Rakesh Kumar Jain to give his initial comments, and then we can move on to Q&A. Over to you, sir.
Thank you, Mr. Varatharajan. Good afternoon, everybody. My dear friends from investors and analyst community, a very warm welcome to GAIL's earnings call for Q3 financial year 23. The physical and financial performance for the quarter ended December 2022 is already shared with you, and the same has been made available on the GAIL's website. As communicated by us from time to time during various earnings calls and various meetings, that the company is into a very challenging business environment for reasons known to all. The disruptions in supply of LNG cargo by GMTS continued during this quarter also. However, we have taken a lot of mitigation measures in order to maintain the supplies and to protect our profitability. During the quarter, we have witnessed high volatility in spot LNG prices, where the prices moved from approximate $45 per MMBTU in the month of October 2022 to $20 per MMBTU by the end of December 2022. That's a swing of almost $25, which has actually led to significant inventory loss. This is to the tune of rupees 1100 crore. This is one of which we never saw. This is one of the major item in this Q3. We booked inventory loss of around 1100 crore rupees. For the unsold volume, which is equivalent to approximate 2 cargoes, which we purchased during October 2022, at that time prevailing market price. Now I would like to share the performance highlights of this quarter. GAIL's turnover stood at rupees 35,316 crore in the current quarter, as against rupees 38,440 crore in Q2 financial year 23. There is a decrease of approximate 8%, and this is mainly due to lower volumes in natural gas marketing, natural gas transmission, and petrochemicals segment, along with decrease in average natural gas price. If you see the average natural gas price which we sold in quarter 2 has decreased by almost $1, which was average 13.27 in Q2, has gone down to 12.27. Decrease in average price realization in petrochemical and liquid hydrocarbon segment by rupees 11,700 rupees per metric ton and rupees 7,300 per metric ton respectively. The PBT during the quarter decreased to rupees 223 crore as against rupees 1876 crore in Q2 financial year 23. This is down by 88%. And this is mainly due to decrease in gas marketing spread, and I also shared just now booking of inventory loss, which is one-off. Lower PC and LHC price realization and increase in fuel expenses in natural gas transmission on account of deallocation of domestic gas, that is to the tune of 0.45 MMSCMD from gas transmission segment. You may be aware that there is allocation of APM gas of 1.55. There was allocation of 1.55 MMSCMD, which was reduced to 1.1 during August. And since this has happened all of a sudden, so therefore we had to purchase spot gas in order to meet the requirement of compressor fuel, which we are booking, and of course this is available as a transmission tariff when the regulator revised the tariff. But for the current quarter and also some what we booked in last quarter, the transmission segment has been hit by approximate rupees 400 crore on this account, 400 plus. The PAT during the quarter decreased to rupees 246 crore as against 1537 crore in Q2 for financial year 23, down by 84%. If we talk of 9 months basis, GAIL clocked a turnover of rupees 1,11,292 crore as against rupees 64,517 crore in corresponding period of the last year, thereby registering an increase of 73% if we compare with last year. And this is again mainly due to increased gas price, higher price realization on 9 monthly basis in petrochemical and LHC segment, which is partly offset by decline in volume in natural gas marketing, natural gas transmission, petrochemicals and LHC segment. There is a decrease in PBT by 40% on 9 monthly basis. PBT is 5993 crores as against 10,044 crore, and PAT gone down by 39% to rupees 4698 crore as against 7681 crore. Coming back to physical performance, gas marketing volume stood at 89.89 MMSCMD in the current quarter as against 92.54 MMSCMD in previous quarter. The decrease in volume is mainly due to our mitigation efforts. As you know that GMTS volume is not coming, therefore we have put supply cuts, and that is why it is resulting into the decrease in gas marketing volume. This has been, though there was a decrease of approximate 5 MMSCMD, but this has been offset by increased overseas sales. So on and all, around 2.5 MMSCMD overall basis, gas marketing volume has gone down. Natural gas transmission volume stood at 103.74 MMSCMD in current quarter as against 107.71 MMSCMD in previous quarter. The capacity utilization was 50% again. Again, a lower transmission volume is attributed to again the same region, GMTS supplies. The polymer production stood at 68 TMT as against 95 TMT in last quarter. The production has decreased due to operation of plant at reduced load to manage shortfall of volume arising due to supply disruptions. LHC production stood at 247 TMT as against 228 TMT in previous quarter. The capacity utilization was 69%. LPG transmission remains almost flat, 1101 TMT as against 1100 TMT in the previous quarter, and the capacity utilization was at 115%. On consolidated financials for Q3 23 as compared to Q2 financial year 23, the consolidated turnover in current quarter stood at rupees 35,870 crore versus 38,674 crore in previous quarter, down by 7%. PBT in current quarter is rupees 662 crore as compared to 1675 crore in Q2 financial year 23, down by 60%. The PAT is rupees 414 crore as compared to 1315 crore in Q2 financial year 23, down by 69%. Consolidated financials for 9 monthly basis, the consolidated turnover for 9 months up to Q3 financial year 23 stood at rupees 1,12,445 crore versus 65,373 crore in corresponding period in previous year, up by 72%. The PBT up to Q3 financial year 23 stood at rupees 6567 crore as against 11,088 crore in corresponding period of previous year, down by 41%. The profit after tax stood at 4982 crore for 9 months in financial year 23 as compared to 8802 crore in corresponding period previous year, down by 43%. In terms of capex and funding, GAIL has incurred capex of rupees 2311 crore during the current quarter, and rupees 6278 crore on 9 monthly basis from April to December, mainly on pipeline, around 3648 crore, petrochemicals around 675 crore, operational capex around 620 crore, CGD projects around 160 crore, E&P 210 crore, equity contribution 965 crore. We have planned to spend approximate rupees 8,000 crore in the current financial year on pipelines, petrochemicals, CGD, equity, etc. Further, during the quarter, GAIL has issued funds, has raised funds of rupees 1575 crore by way of issuing bonds for 5 years at a very competitive rate, that is at the rate of 7.34% per annum, which is better than even the AAA rated corporate bonds, PSU bonds, and the rates discount of various PSUs at the time in the range of approximate 7.45% to 7.59%. The total outstanding loans as on 31st December is 10,164 crore. For GAIL CGD business, GAIL is having infrastructure of 124 CNG stations and 234,000 DPNG connections. During the financial year 22-23, 5 new CNG stations, around 32,700 new DPNG connections were added. The physical volume supplies to these GAIL CGDs is 0.22 MMSCMD during the year. In the next 2 years, GAIL's target to add over 100 new CNG stations and 250,000 DPNG connections. Let me talk something about the GAIL Gas. During the current quarter, the gross turnover stood at rupees 2623 crore as against rupees 2716 crore in Q2, decrease of 3%, and again mainly due to the decrease in average sales price. The profit before tax has increased to rupees 112 crore in current quarter as against 101 crore in previous quarter. Profit after tax has increased to rupees 87 crore as against 71 crore in previous quarter. The physical volume during the quarter remains flat, almost 5.5 MMSCMD. During the Q3 financial year 23, 8 new CNG stations and 9,500 new DPNG connections were added. During 9 months period ending December 2022, 19 CNG stations and 39,000 DPNG connections were added. Out of these, 10 CNG stations have been added at Bangalore location. GAIL Gas, along with its joint venture subsidiaries, has infrastructure of 818,000 DPNG connections and 358 CNG stations, out of which Bangalore contributes 79 CNG stations and 228,000 DPNG connections as on 31st December 2022. With respect to project performance, Mumbai-Nagpur-Jharsuguda pipeline is of 1,755 km. Activities are moving in full swing, and Mumbai-Nagpur section is expected to be completed by May 23. Regarding Jagdishpur-Haldia-Bokaro-Dhamra pipeline, 50% of that is 1,770 km out of total pipeline length of 3,384 km have been commissioned, and remaining part is expected to be completed by June 23. The SAPL, the trunk line, is likely to be completed by July 23. Further, in relation to PDH-PP plant at Usar, presently the tendering activities, other enabling activities are in full swing, and project is slated to commission by April 25. Regarding PP plant at Pata, various LLIs, tendering activities and site enabling activities are in full swing, and project is slated to be commissioned by April 2024. Now, I wanted to give you some outlook on our various segments. As I shared, the natural gas transmission business, because of these supply cuts in current financial year, almost 10% transmission, almost approximate 10%, there is a downfall of 10%. And in view of reduction of APM supplies for compressor fuel, there is an impact of another 0.45 MMSCMD. These two are the regions which has impacted, and we hope that next year we will be able to achieve our normative volumes, which we could not do this year. So this has an impact, both have impact of almost 1,000 crore this year, and hopefully this will be taken care in next financial year. Then, coming back to the gas marketing, this year we faced, because this was all of sudden activities, geopolitical situation, GMT supply. So we are in the market for sourcing of gases. We are in discussion with various suppliers, and we hope that we will be able to enter into a deal for meeting our increasing supply, increasing demand for a downstream customer. Apart from that, we are also in discussion with GMTS so that the supply is restored to a normal level. One more thing, I would as supplies to the Jagdishpur-Haldia-Dhamra pipeline is increased, our average tariff realization has increased, during this year, which used to be 39.78 has gone up to 43.46 per MMBTU. And going forward, the supplies to the Jagdishpur Haldia pipeline, or rather use of multiple pipelines will increase. Therefore, there will be further increase in tariff realization. Apart from that, the tariff for Jagdishpur Haldia pipeline as on date has been worked out considering the phase 1 capex, which was approximate rupees 2,000, and if we reduce the subsidy around 12 to 1,300 crore rupees, whereas total expenditure net of subsidies around 10,000 crore. So once the regulator takes care of these facts, the tariff for Jagdishpur Haldia pipeline, which is currently around 65 rupees per MMBTU, is certainly going to be doubled. We have already filed our tariff petitions with PNGRB, and PNGRB is reviewing the same. Apart from that, we have also filed the tariff in line with the revised parameters which notified by PNGRB, and also with respect to integrated tariff notified by PNGRB. PNGRB is reviewing the same. Just to take you through and recap, the PNGRB has recently made changes in their tariff regulations. I will like to highlight some of them. They have given, earlier the volume ramp-up benefits were available for first 5 years from the date of commissioning of pipeline. Now that it has been increased to 10 years. And apart from that, what they have done, it will be available phase-wise. So our at least 3 pipelines will have benefit of that. That is KKMBPL, Dabhol, Bangalore, Jagdishpur, Haldia pipeline. Second, PNGRB through an amendment to tariff regulation has also given that the benefit of reduced, basically GAIL has adopted the reduced corporate tax rate. So earlier there was apprehension where tariff will be revised. So because earlier tariff normative rate was considered about 33-34%, apprehension was that will be set off through tariff through adjustment and revision in tariff for by 25%. Now PN given that benefit that it will only be adjusted from the financial year 22-23, so that significant benefit is now available. Third, the PNGRB through its amendment in tariff regulation has also allowed the benefit of transmission loss, a normative loss 0.1% without any subject to adjustment. Basically, it will be available on actual throughput. For PNGRB, if you have gone through the regulations, in terms of PNGRB regulations, the volume denominator is considered as normative, whereas fuel consumption is considered on actual basis. Now PNGRB has again revised this regulation. The fuel consumption will also be almost normative. In terms of regulation, it will be subject to maximum 2% of volume divisor considered instead of actual. One more regulatory amendment which PNGRB has done, that earlier miscellaneous income were used to be set off through the expenses. Now the miscellaneous income will not be set off until and unless we reach to the level of 12% post-tax return, or 75% volume, not post-tax, 75% volume. That 75% volume anyway provides the 12% post-tax return. As we shared in the last on 31st May 2022 during the analyst meet at Mumbai on 31st May, that we will be getting at least 2,500 crore rupees of marketing spread in gas marketing. I am happy to share that in 9 monthly basis, in spite of all those challenges, we have achieved at least 2,500 crore rupees of marketing spread. And primary reason is that out of 5.8 MMTP volume we source from United States, almost more than 50% we have signed on Henry Hub linked contracts. So those kind of risk has been mitigated. More and more customers are coming forward to sign Henry Hub linked contract, and that will further taken care. The risk of basis risks will further be taken care. GAIL is now active participants to exchange. We are sourcing the good amount of gas from exchange, and in last Q3 we have sold almost 120 MMSCM of gas from exchange at a very competitive price. One more positive which is going to happen in next year, that we sold half MMTP of gas in international market for 5 years. That 5 years is already over. So those 8 cargoes, half MMTP gas will be extra available to be sold in the domestic market. I think this is broadly from my side. And one more positive which will come for LHC segment, as we all know that Inquiry Committee has recommended for a cap price for LSC, which is around 6.5. Currently, the price is around 8.57. So input cost for our LSC has gone up significantly. If these recommendations are accepted, then assuming all parameters remain same, it has a significant upside around 1,000 crore to 1,200 crore. Thank you very much.
Open the floor for the Q&A session.
Yes,
please.
Thank you, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Probal Sen from ICICI Securities. Please go ahead.
Thank you very much for the opportunity. Good evening, sir.
Good evening, Probal.
Thank you for the detailed explanation of why the results have been a bit weak for this quarter. That is very useful. I had two questions. One was, sir, the disruption in the Gazprom supply happened a few quarters back, from what we understand. So volumes, anyways, have fallen from about, I think, 114 MMSCMD levels to about 107, 108 for the last 3 quarters. Just wanted to get a sense of the additional 3 to 4 MMSCMD fall in this quarter. That is a result of what you were talking about when you said you had high-priced cargoes, whereas the current prices have dropped. So the inventory loss is also one of the drivers for the volumes not being sold, and therefore transmission volumes were also lower this quarter.
Probably, I think just don't see that this quarter independent. We actually started reducing cut to downstream customer. In fact, sometime in August, July 2nd fortnight, and also we have ramped down our Pata petrochemicals sometime September, and then for a moment, for a few or for almost 30 days or so, we stopped during October. So the impact in quarter 2 was there, but not to that extent. But the full impact of supply cuts actually has happened in Q3.
Okay.
That is the reason. If you see, compare quarter to quarter 3, you will not arrive at that figure, because quarter 2 was not fully comparable. Supply cut was for a partial period. Pata was running. It is quarter 3 which has seen the actual impact.
Got it, sir. Perfectly clear. The second question was around the measures and the things that you spoke about on the tariff front. Obviously, all of these measures will be particularly positive. Is it possible to put any sort of percentage? Now, you mentioned, of course, about blended tariff going from 39.8 to around 43.5 rupees already.
Actually, it will not. I got you. It will not be right idea for me to give you exact number, but because it is regulator to decide. But if you talk me or a ballpark figure, because there are a lot more adjustments apart from this. Because there will be capex adjustment, OPEX adjustment, past over recoveries. But if you talk to me independent of these factors, it is 10 rupees per MMBTU at least.
Got it. Just as an indicative range. That is very useful. Last question.
For only these factors, I am taking independently.
Got it.
That is coming.
Got it.
Not less than 10 rupees.
Yes, of course. The regulator can always, sort of disallow some expenses here and there, and so on. That can happen.
They allow, because it is almost 25% of current tariff.
Got it, sir. The last question, if I may, on the petrochemical front, utilizations have already dropped quite a bit. So for FY24, given that we do have some visibility from some domestic sources, and I think earlier guidance was that volumes ideally should go up, improve from these levels gradually. what sort of utilization level should we be building in, sir, or should we be working with for the petrochemical business? Assuming some gas once again starts to become available and you don't have to sort of cut utilization this sharply for FY24.
For FY24, look, we are currently running our Pata petrochemicals at almost 40%, and the reason is that we want to continue to supply to end consumers.
Sure.
At least we are able to satisfy them, and they continue to remain with us. As far as your question, what level we look for 24, we are actually working on sourcing of gas, and we are hopeful that we will be successful. And why should I give you a number of 42, 80 or 70? We intend to run at 100%.
Got it, sir. Got it. Fair enough, sir. Fair enough. I guess we'll know that answer as we go along. Thank you so much. I'll cover more questions. Thank you so much.
Sure.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to answer questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We have the next question from the line of Amit Rustagi from UBS. Please go ahead.
So thanks for taking my question and explaining all the results in quite detail. Sir, my first question relates to the tariff. You highlighted that around 25% tariff increase. So are we looking at the integrated tariff to be 25% higher than the current realized one? And broadly, if we can assume that this will have 15-year or 20-year of life, or what are the assumptions in that?
I have not considered any integrated tariff benefit which will be available. As I said, I have only considered those factors which have come through regulatory amendment, and by putting on the model what kind of impact they may have. I indicated the ballpark impact. If I say for 40 rupees average tariff today, they may have around 10 rupees impact of these factors. Integrated tariff, when it comes, it will have a different kind of benefit. Apart from the increase in revenues, it will also have benefit of market expansion. What we as a company look integrated tariff as a market expansion tools, because now market is is away from source, away from the western region. It is more in a northern and eastern part of the country. So we look integrated tariff from different perspective, apart from the benefits which are available as an integrated tariff that we have not worked out.
And sir, what are the expected timelines? Can we expect all these tariff orders to come before March 31st?
Yeah, so we have submitted our tariffs. As we understand from PNGRB, they are in the process of making public consultation document. If based on our understanding, if everything goes right by end of this month or maybe next month, public consultation document will be available, and that will give you fair idea about the tariff submissions, tariff moderations, or what way the tariff will go. But let me not focus on to this. Actually, this anyway will happen. What you as a analyst or investors should look, as I said, the Dishpur Haldia pipeline tariff has yet been notified, which was notified sometime in 2018-19. Considering only capex of around 1500 crore, I don't have right figure right now, because 2000 crore were total capex, then the subsidy was reduced from that. Whereas total capex for this pipeline is 15,000 crore. 5,000 crore if you reduce subsidy, 10,000 crore we have almost incurred. Now on NPV basis for last 3 to 4 years, tariff is going to go substantially up. Currently tariff is 65. Even if you consider on a conservative side, on independent pipeline, it will not be less than 125, 130.
Okay, sir, got it. So you have already fairly detailed.
That's a factor, because that is the major thing. Let us forget the tariff regulation amendment, the integrated tariff. This is anyway available to us. Apart from that, KKMBPL tariff is also due for revision. The public consultation for the same was done in 2019. It has also good upside. The Chensa pipeline, Dadri Bhavana pipeline, for which consultation also was done in 2019, we expect there will be some kind of upside available. Then the tariff regulation amendment, and then you come to the integrated part.
Okay, sir, got it. And sir, my second question relates to the US LNG contracts. So now you mentioned that 0.5 million ton additional LNG will be bringing. So in total, how many cargoes we are likely to bring in 2023 in India? And what is the average landed price, including the spot transportation cost we have? And how much this is like over and above 2022
So we have
cargoes?
almost 90 cargoes from the United States, and we intend to bring all of them to India. And coming back to your transportation cost, actually it depends because we are not directly bringing all these cargoes through our charter ship. We are using lot of optimization mechanism like time swap and the destination swap, FOV sales and DS buy, which gives us a lot of flexibility and saving in transportation cost. So that depends on what kind of deal we click. But if you talk me of normative transportation tariff, it ranges from $2 to $2.5.
Okay, sir. Given this scenario, now shall we expect that CGDs, which were getting almost 50-60% cut in the US LNG contracts tied up with GAIL, they will start to get the full LNG because you will bring more cargoes in 23?
Hey, CGD was not getting cut because of the US gas. It was because of GMTS.
Okay, but their contracts were, I think, linked to Henry Hub, right? So no.
Most of CGDs, there may be some, but we have not put the cut because of the Henry Hub.
Okay, sir. Got it. Sir, I'll come back in the queue. Thank you, sir. Thanks for taking my questions once again. Thank you.
Thank you. We have the next question from the line of Puneet from HSBC. Please go ahead.
Yeah, thank you so much for the opportunity. My first question is with respect to the loss that you've booked on the transmission, 400 crore. When do you think you'll get the approval from PNGRB to book it back as income in your P&L?
Puneet, let us not look it as a loss. This year we booked more expenditure of 400 crore. Actually, the tariff revision takes place in a period of 5 years, and we can go to regulator even earlier if there is a significant change in parameter. We have already gone to the regulator for considering this fuel expenses apart from other factors. What I said earlier also, the tariff petition has already been submitted. They are under process. They are reviewing. A PCD is likely to be available maybe by next month, if not this month. And then normally it takes 3 to 4 months to PNGRB to finalize the tariffs. So safely next financial year, April or May, we will be able to see the revised tariff.
And then you can book it back in your P&L.
Yeah, then revenues are available. Actually, what is happening, it has a double impact. This year we have booked, say, 400 crore rupees expenses extra, which is not available. Next year, this 400 crore will not be there because now we have a time to source cheaper gas. Because that time the prices were 40. Now you can buy gas at 20, 15. So those extra expenses will not be booked next year. Apart from that, we will have increased revenue on account of revision in tariff, considering this apart from other aspects.
Okay. And that will be booked as one-time income, or will that be spread over a longer period of time and revised?
It will be over economic life, because when they work out the tariff, they spread it over economic life. So 400 crore will not be available at one time in next year. 400 crore expenses may not be there next year, but the revenue will be available in a period of economic life depending upon the life of the pipeline. In this case, HBJ, which has a life till 2033.
Okay. Understood. My second question is, how much gas is now going via the Jharsuguda pipeline?
No, nothing. Abhi, pipeline is under construction.
Okay, nothing. So that the normative tariff that you talked about will start. You're saying that impact, that number will go up later only.
No, that is a bid out pipeline. There will not be any change in tariff of Mumbai-Nagpur Jharsuguda pipeline.
Okay. And on the inventory loss of 1100 crore, at what LNG price was that determined? And is there a risk of more loss going into this quarter as well?
We have almost booked that because we purchased around $40. I don't have the exact data, and already we have valued the inventory as on 31st December price, which was around $21, $22. So majority of loss we have booked. So we don't expect that it will happen again.
Okay, but there's still a reduction. You said it's about $14-15, so $5 further down, right?
No. Already say $21-22 we have valued it. So what will happen now? If you see, it may be $14, $15, or if price increase, spot price increase, it may not, we may not require to book any loss. So $21 is not a very significant price level.
Understood. That's very helpful. That's all from my side. Thank you.
Thank you. We have the next question from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Yeah, thank you very much, sir. So my first question is just trying to understand the inventory loss better. So essentially the loss arose because GAIL took an open position without a back-to-back contract with a buyer in this environment, and hence there is a price loss?
No. You know that during October, the prices of LNG were hovering around 45, and we purchased at a better price, not at 45, lesser than the $45. And you also know that on quarterly basis, fertilizer bidding comes. Okay, we purchased 3 cargo, and we got the contract. We supplied some of the quantity to them, but in view of significant volatility, the fertilizer came out with another bidding in December, and they did not take the volume at that price. So that is how that volume remains. So we did not take any speculative or open position. Certainly, this is a continuous affair that fertilizer bidding comes. You have to quote that, and based on your likely volume available, you purchase that. But what has happened by December, the prices went down, so there was less offtake.
So essentially, sir, with the fertilizer segment as a buyer, the price risk is essentially borne by GAIL. Because if tomorrow there is another price drop, because LNG prices are expected to remain volatile, then that inherent volatility will be there on a quarter-to-quarter basis, especially in an environment like this. There is no price sanctity with the fertilizer segment.
No. This on a routine fertilizer supply, which is 90% we are supplying on our contract. There is no volatility involved. There is no price risk involved. It is only when we bid. When we bid through EPMC, then we take positions. But this has never happened in past. So this is one of situation which has happened, that price went down from $45 to $20. So that's why it happened. Now we also have seen the market, how market behaves. So accordingly, we will be taking position. But we also don't expect that prices will move 45 to 20, because this was a unique situation.
Sure, sir. So my second question is just trying to understand the petrochem segment utilization better. Now, if oil prices were to remain at this levels through the year, and hence end petrochem prices were to remain at these levels, then at what spot LNG prices can utilization go back to 100%? At $20, can you operate at 100%, or you need a lower LNG, or you can operate at a higher LNG?
If the petrochemical price remains at current level, we will be able to operate our plant at 100% around $16 plus.
$16. So at 2021, sir, then the utilization to come off.
That's what I was telling in response to earlier question, that why we expect 40 to 80. We expect 100% because we don't expect price to remain at that level.
Understood. That's very clear. Thank you, sir.
Thank you. We have the next question from the line of Sabri Hazarika from Emkay Global Financial Services. Please go ahead.
Yeah, good afternoon, sir. So my first question is regarding the LNG scenario right now. So how has been the experience so far in terms of like getting long-term deals as a replacement to Gazprom and also to add to your portfolio? So there has been some news regarding I think that you are almost close to signing a deal with ADNOC also. So just wanted to know some idea on this.
My colleague, Mr. Kaviraj, is Executive Director, LNG, will share the details. But news, let us not go by news. We are not only in talks with ADNOC, we are in talks with many parties, and probably we will be getting a good deal. But with a specific answer to your question, I request Mr. Kaviraj to tell you.
Good afternoon, everybody. As our Director of Finance rightly said, we should not go by news articles. But fact remains that we are actively in discussion with a couple of long-term LNG suppliers, and the discussions are at various levels with different parties. But since this being a long-term contract and market is also quite volatile, we are it is taking more than expected time, but we are expediting it. Hopefully, we should be able to conclude at least one contract shortly.
Right. And second question is on your overall gas volumes outlook. So we have seen that dip, but I think with spot LNG prices also cooling down, if we look into the numbers which have been stated by PLNG also, I think they have also been back to something like 80-81% utilization. So are you seeing better numbers in Q4, and what is your guidance for FY24 as a whole, both transmission and marketing?
Let us not immediately look that Q4 will have miracle. We expect that Q4 certainly will be better than Q3, but in 24 we are hoping that we'll be back to normal.
Normal is in 110 plus for transmission?
Yeah. Anyway, we are still running 104, 105, 110. Why 110? Why not 113, 14?
Okay, sir. And your marketing EBITDA number is also like based on, say, 9,500 volumes, right? Or 2,500 crore number that you have given?
Yeah. So whatever number I have given for 9 months is based on the current level, which are actual numbers.
Right, right. So, but minimum 2,500 for FY24 also you are pretty confident.
So anyway, what happens when I made this statement on 31st May 20, because investors and analyst community has concern about gas marketing that you don't look at it as a sustainable segment. But we said in that meeting that you can look for at least 2,500 crore PBT from this segment. And under the current volatile market, we have been able to maintain 2,500 crore in 9 months. So we expect that in 24 we will do far better than this, particularly because we will have more supplies. That's what we expect. Second, we have signed a lot of back-to-back contracts, thereby avoiding the price risk. So we expect that we should do better as compared to this year, even in gas marketing.
Okay, sir. Fair enough. Thank you so much and all the best.
Thank you. We have the next question from the line of Yogesh Patil from Centrum Broking. Please go ahead.
Thanks for taking my question, sir. So the question is related to a current gas trading environment. Looking into the January average Henry Hub prices, which is much lower, and India's landed price of Henry Hub would be lower than $9 per MMBTU, considering the $2.5 per MMBTU transportation cost. So what we understand, sir, the same gas is being sold to various consumers at $12 to $13 slope to Brent. So it suggests that GAIL is making handsome trading margins on Henry Hub. Is it right understanding?
As I shared with you, that more than 50% contract for Henry Hub gas we have signed back to back. So irrespective of Henry Hub level, we remains neutral. Okay, and this we signed in order to avoid the price volatility, makes the segment consistent. Now remaining 50%, yes, there may be upside, there may be downside, but what we do, we take positions in paper market, because in order to avoid this price risk of crude versus Henry Hub volatility, we take time to time positions in paper market, and therefore we avoid those risks and try to remain consistent. So we don't see any windfall or any extraordinary profits, but certainly we will be able to maintain our profit.
Okay. The second question is related to, again, rupees 1,100 crore inventory losses on the trading side. So can you please provide the same like-to-like inventory losses or gain in the previous quarters, if happened in the Q2 FY23 or Q3 FY22?
I don't have any figure ready-made, but I can say you this was, I think not, but it was not, even if it was not significant. That's what I am not able to remember. So there was nothing which was considerable. I think it was not there, but it was not considerable even because significant thing anyway we ourselves shares with you.
Okay, sir. Thanks a lot.
Thank you. We have the next question from the line of S. Ramesh from Nirmal Bang Securities. Please go ahead.
Good evening and thank you very much. Can you hear me?
Yeah, I can very well hear you.
So going back to the tariff regulations and the outlook for the gas transmission business, when you indicated the current tariffs and the potential increase in the tariff, these are gross tariffs, before operating expenses in line with the regulator announces, or these are at the EBIT level? How should we read that?
These are gross.
Gross margin. Okay. And so if you're looking at the economic life, according to the new regulations, the economic life is 25 years. So this new economic life of 25 years will apply only to the new pipeline, and HVJ will remain at 2033?
Let me tell you, economic life always has been 25 years. There is no change in regulatory provision. But what is the regulatory provision is that what is regulatory provision? What is in practice what PNGRB is doing? When PNGRB notified tariffs in 2018 and 19, even though in terms of regulation the economic life is 25 years, for the purpose of computation of tariff they consider 30 years. Second, there is another regulatory provision that after completion of economic life, there is a provision for extension of economic life by 10 years. So if you see, HBJ was first commissioned in August 87. If we go by those regulations, the economic life was over in 2012, but regulator has increased the economic life, say around to 2033. It means they have increased the economic life more than twice. So economic life, provision of economic life increase is there in the regulation, and which is being done by PNGRB. Whenever they work out the tariff, if required that economic life is over, they increase after assessing the health of the pipeline.
Okay, so I know because one of the other companies in transmission suggested that the regulator will look at the entire gas grid and fix an economic life uniformly for the entire system. That's why I asked that question. So you are saying that applies.
There is no entire system as on date. As on date, pipelines are individual pipelines. If you see economic life of HBJ, I said around 2033. If you see Dhabol, Bangalore, it is around 2038. KKMBPL around 2038. So it is pipeline to pipeline. I am not aware which grid they are talking about, but what is the current situation I have shared with you.
Okay. And if you are looking at your petrochemical and LPG and hydrocarbon business, when you talk about the potential upside, say in LPG and hydrocarbons from the reduction in APM gas prices, what is the kind of outlook you have for your end product prices, given that there is some volatility in oil prices and LPG markets? Do you expect the current end product prices to sustain? What is the outlook there?
Actually, I cannot predict about LPG price, what will remain in future. But what can I see? Current prices, if you see historically, in winter LPG price goes up. But this is the unique year where LPG price has gone down in winter. So if nothing happens, this price may be sustainable price. But future, I cannot predict what will be the LPG price.
So one last thought, since OMCs have got some compensation for under recovery on LPG, is it possible that you can also make a similar claim, or because it's based on the increase in APM gas prices and this LPG is going to the public distribution system, is there a case for GAIL to also make a claim?
No proposal is there. No such proposal is there with us.
Okay, thank you very much. I'll join this.
Thank you. The next question is from the line of Mayank Maheshwari from Morgan Stanley. Please go ahead.
Thank you for the call, sir, and the detailed answers. Just one question from my end, and this was regarding the GMPS supply. I think you were sharing around your strategy around trying to kind of get your long-term contracts. Can you just give us a bit more detail of by when this 8-9 MMSCMD of volumes you'll be able to kind of fully get back on a long-term basis?
Actually, we are also not clear when we will get back. We are pursuing or in discussion with the supplier, and those outcomes still are inconclusive. We are still under discussion. So until those are concluded, it will be difficult for us to predict when will we get the full supply.
Sir, I was referring to not just from the original supplier, but to just the other factors, other contracts you were trying to kind of negate of this effect. Is there a thinking process around when you can at least get to long-term supply contracts with some other suppliers to kind of negate off the pain on GMPS?
Yeah, one is GMTS, which we discussed, but anyway, Indian economy is needing more and more gas. Even if GMTS would not have happened, we were in the market for sourcing gas, but GMTS circumstances has forced us more that not only we source to increase market demand, but we source little more than that, so that even if the GMTS comes, we are able, even if GMTS is getting delayed, we are able to serve the market. And even if GMTS comes in full, we have flexibility to trade in international market. You must have seen that in past we have sold almost 10 MMSCMD of gas, which is almost equivalent to GMTS volume in international market, because that ability we have because of the FOB contracts from United States. So we are in a better position that even if we source equivalent to GMTS, little less than GMTS, apart from increased demand, we will be able to not only supply to our Indian market, but we will be able to play more in the international market.
Got it. So is it fair to say whenever your contracts come in and you are able to source alternative supplies, it will be mostly linked to Henry Hub kind of contracts rather than any oil-linked contracts?
No. We are not particular about Henry index. We look for as a portfolio, as a gas major in the country, we look for all kind of index as long as the prices are affordable to customers in India.
Got it. Okay. Thank you.
Thank you. Participants, please note, may we request to limit your questions to one participant. Thank you. We have the next question from the line of Aditya Suresh from Macquarie Asset Management. Please go ahead.
Thank you, sir, for the time. I had two specific questions on gas marketing. First is on the entire kind of supply issue, right? So obviously the Gazprom contract is 2.5 million tons. Our US supply is 5.8 million tons, right? So I guess what I'm trying to get at is how much of your US volumes becomes available to offset Gazprom and by when? Or if I had to rephrase it differently, you said that your US volumes, about half of it is kind of free. That would then tell me that you can offset full Gazprom exposure by bringing those volumes to India. So can you just give some understanding of that? How much, by when can your US volumes, when they kind of go off these hedges, you can offset the exposure from Gazprom?
We are not clear what you mean by 50% is free. Can you just elaborate?
I think in your remarks you had mentioned something about some of our US volumes are already kind of placed, some of it is hedged, etc. So I was a bit unclear about the comments that you made. But the broader question, sir, is simple. Gazprom, your exposure is 2.5 million tons, and it's a few cargoes right now. US, your supply contract is 5.8 million tons. By when do you get at least 2.5 million tons available to offset this Gazprom exposure?
Yeah, efforts are on, but since we have to tie up on a long-term basis, it will take its time.
So my understanding, sorry to push on this, but my understanding about the US volumes you placed also were more short-term hedges, maybe at best about a year in terms of some of these time swaps, destination swaps, etc. So is that understanding incorrect then?
No, we are not able to understand you first. There is nothing, don't link hedging and the physical.
How much of your US volumes can you bring to India today and in FY24?
All we will be bringing to India. All 90 cargo, approximate 88 to 90 cargo will all be bringing to India.
Okay. And with that, can you therefore then fully offset the Gazprom exposure?
No.
Okay.
Otherwise, we will not have, our sale will not have gone down, isn't it?
No, I guess, sorry again to push, but I guess my real question is that clearly you're not bringing all your US volumes to India today, right, in FY23. some has been sold
Let me
in
tell you,
international market as well.
this financial year we are not bringing all because 8 we had already sold in the international market. That contract is over. So those extra 8 cargoes or half MMTP will be available. That is extra from US, which is available to country.
Okay. And just one final piece is in terms of your gas marketing volume mix today, are you able to kind of distinguish between how much is back-to-back in nature?
So we have 14 MMTP of portfolio. Let me give you full breakup. We have 14 MMTP of portfolio, 2.5 or you can say 2.85 at peak. Gazprom is not available. 11 million. RAS gas almost is back-to-back. Then we have signed almost 50% of out of 5.8 Henry Hub on back-to-back. Okay, and that is around you can say 7 million ton we have on back-to-back out of 11 if you reduce the Gazprom. So remaining we have contract on different linkage, and we are supplying, say purchasing Henry Hub, supplying our crude, but then we are taking positions to mitigate those risks.
Okay, thank you.
Thank you. The next question is from the line of Vishnu Kumar from Spark Capital. Please go ahead.
Good evening and thanks for your time. So you mentioned that you're working on some LNG deals. What would be the indicative slopes that probably we might be getting if we conclude a deal, or what is the current running rates like?
I think we will not be able to share even after conclusion.
Okay. Sir, for quite some time we've been sourcing a lot of spot LNG for our petrochemical division. Now, let's say if you're bringing 500,000 ton of the US gas to India, or let's say if we conclude a deal, would we insulate our petrochem division going forward with 100% some kind of a lock-in and not rely on spot gas?
You are right. We are looking for additional gas. That's how we are looking for additional gas. We are earlier also not relying on spot gas. Let me be very frank with you. It is only because of GMTS, which is substantial volume has gone down, 10 MMSCMD. So one of the internal consumer got affected. So earlier also we are not running Pata Petrochemical on a spot. Nobody will do that. No planning is done on a spot. So now unfortunate event has happened and we are looking for another alternative long-term basis.
Understood. So whenever we get for the next volumes, we will be locking 100% at least, if not GMT is not available.
We always do that. It is only currently because of all of a sudden it has happened. Otherwise, we never do run plant on the spot.
Got it. And finally, for volumes to pick up in the country, what level of pricing do you think at least you see the gas demand coming back? We've seen country level demand also come off a little. So what level of spot LNG, let's say if you think maybe $14-15, or then you start see some pickup in demand?
But it's a difficult question at what level of, because every consumer has a different appetite level. If you take of fertilizer, it depends at what level fertilizer is imported in the country. Power, you know that it doesn't come under merit, so RLNG has a challenge. CGD, it depends on alternate fuel with their source diesel because they replace largely the diesel. So for them, the crude is the alternative fuel. So every consumer has a different level of affordability. And that's how we in our portfolio keep all kind of gases so that we take care of most of the customers. So no single price I can say which is actually okay for increase in gas market, because we look for all kind of market and try to satisfy their requirement from our portfolio.
Got it, sir. And just one to confirm the previous answer that you mentioned, you expect that the PNGRB tariffs for your major pipelines to be done in the next couple of months. Is that right?
We expect at least by April it should happen, because already we have submitted. They normally take 3 months, and we are also pursuing so that it actually is notified, say by April, if not April, mid-April or end of April. We hopeful that it will be done.
Got it, sir. Thanks and all the best.
Thank you.
Thank you.
Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Varatharajan Sivasankaran for closing comments. Over to you, sir.
Thank you, Michelle. So in case you have any final comments to make, please go ahead.
It was pleasure talking to you all, and if we could not answer any of your question or some of the participants might have missed, we are always available offline and happy to answer your questions.
So if I may, I had one last question.
Yeah.
So in terms of the new regulation in terms of what government has highlighted for KG Basin hydroxide and pressure gas, does it reduce our appetite in terms of bidding, in terms of volume, or does it reduce our maneuverability in the overall scheme of things in terms of placing those volumes?
So I will ask my colleague Sumit to answer this. The ceiling on HPST, or you can repeat so that
Can you please repeat the question? Sorry, I missed the question.
So obviously, they have reduced the marketing margin or restricted the marketing margin. So does it reduce your maneuverability in terms of placing those volumes, and does it reduce your appetite in terms of bidding for those volumes?
Can you see, as per the new HPST order by the Government of India, the priority, in case it reaches the pro rata distribution, the priority is given to the CNG PNG segment and then the fertilizer segment. So of course it does ensure availability of fuel for as far as GAIL is concerned for our own CGD consumption to the extent of CNG PNG consumption. But yes, it does decrease the maneuverability for the trading segment and even our own consumption, because the priority sector will get a higher priority.
Perfect, sir. Thank you, sir. And I wish to thank all the participants and the management led by Sri R.K. Jain. Thanks for taking time out to join this call. Have a nice day, everyone. Thank you.
Thank you.
Thank you. On behalf of Antique Stock Broking, that concludes this conference. Thank you for joining us, and you may now disconnect your